We will be covering chapter 10 in this video. So we are talking about, let me go to the PowerPoint. Analyzing departments that have, or companies that have decentralization. Okay. So we're going to talk about responsibility accounting, the 4 types of responsibility centers that we're going to be looking at, why you would choose decentralization. We're going to explain ROI, residual income, and economic value added. Those are the 3 types of problems that you will have to do from this chapter. And then how you evaluate managerial performance. Transfer pricing, we're going to mention it, but there will be no problems on transfer pricing. So responsibility accounting. When information is presented, we need to know who is responsible for what has been achieved. So we want a system of responsibility, accountability, and performance evaluation. Who is responsible for those costs incurred may be the one who needs to take corrective action, or the one that needs to be supervised better to take corrective action. Remember, we have that management control cycle. You first have a plan. Short-term plan is the budget. The long-term plan is your strategic plan, which is typically 5 to 10 years out. You measure actual performance. You compare actual to budget. You put that on a report, which is sent to management. Management does corrective action, which is either preparing a new plan or modifying the plan, or modifying the direction of the employees who are performing. We have 4 different types of centers. What we are doing in this chapter is mainly looking at evaluating investment centers. A cost center, the manager is responsible only for cost. So that would be your production, your schedule of cost of goods manufactured. Okay. Revenue center, you're responsible only for revenues. Typically, revenues are being generated by the marketing department. A profit center is a manager responsible for both revenues and cost. So the profit centers may be developed by product line. It may be by divisions. Then an investment center, they're responsible for revenues, for cost, and investments. Investments, we're talking about long-term investments, typically in fixed assets that is used for the organization. So the production department is responsible for departmental cost. So that is a cost center. The report shows the information by product line. Therefore, you have who the product manager is for that particular product. We are looking at global businesses. Businesses are becoming more and more global. So you need to make sure that you are considering all divisions in the company, not just those that are domestic. So we want to look at actual outcomes versus the budget, and how do you take corrective action. So we have responsibility, accounting, accountability, and performance evaluation. Those 3 are called responsibility accounting. So we've already discussed that. Decentralization. At what level of the organization are decisions made? Decentralization means that the decisions are made at the lower levels. It's made by the individual who has all of the information needed to make the decision, to implement them. Centralization means that the decisions are made at the top of the organization. and the information is communicated down. Whether you have decentralization or centralization within an organization, the one thing that is extremely important is communication. You need to make sure that that communication is going up and down that chain of command. Okay. So the reason you want decentralization is the lower levels have better access to the information. You can get a more timely response. They see things as they're happening and can potentially take corrective action immediately. It focuses on central management. You are training and evaluating segment managers. A segment could be a division or a product line. Motivation of segment managers and enhanced competition. So when we're talking about a segmented income statement, you use the behavioral format of the income statement. Sales revenue minus variable expenses equals contribution margin, minus your fixed expenses equals net income. When you're doing segmented reporting, you separate those fixed expenses between direct fixed expenses directly related to that segment, and segment is a generic term, and you have common fixed expenses. So contribution margin minus direct fixed expenses would give you a segment margin. Then in the total company as a whole column, you would subtract your common fixed expenses to get net income from the company as a whole. Then enhanced competition can be good. How do we improve when you're competing against other divisions, trying to make sure you're doing well? You do have to be careful, though, that the enhanced competition does not cause a manager to do something that's good for that division or segment, but is bad for the company as a whole. So you have to be very careful about this enhanced competition. So units of decentralization, those are the segments. Divisions, you might have a division, and then the division is divided between product lines, or the division might be divided between sales or product lines further separated by sales territories. Okay, so why do you use decentralization? We've covered all of the reasons. The lower levels have better access to the information. They can give a more timely response. It helps expose them to management responsibilities, so they become trained segment managers, and enhanced competition, training, motivation. So evaluating investment centers, that's what the majority of this chapter is concentrating on. We have return on investment, which is actually separated into two separate calculations that we're going to talk about in a minute. We have residual income. We have economic value added. So return on investment is the one that's used most commonly in organizations and by stockholders to determine whether they want to continue to hold the stock or whether they want to invest in a new company. Okay. It does allow you to compare divisions. So the formula for ROI is operating income divided by average operating assets. Operating income is earnings before interest and income taxes, typically used for divisions. There's an abbreviation called EBIT, EBIT, all caps. That stands for earnings before interest and taxes. Operating assets, that's here in this denominator, is all assets used to generate operating income. So if you were holding land as an investment to see if the price will go up to sell it later, That is not an operating asset. So you want only operating assets here. Margin, also called return on sales, is net operating income divided by sales. So ROI was divided into two pieces. It's margin times the turnover. The formula for margin, net operating income divided by sales, sales revenue. Formula for turnover is sales divided by average operating assets. A reminder, average is calculated by taking beginning operating assets plus ending divided by 2. So this is the average operating assets that goes in the turnover and goes in ROI. These are formulas that you will need to know for your exam. The advantages of ROI, it encourages investment on the relationship between sales, expenses, and investment, encourages cost efficiency. Remember, profit is based on revenue minus cost, and it discourages excessive investment in operating assets. The disadvantage, a division might not want to invest in a project that would increase the ROI for the company as a whole, but would decrease the division's ROI. So this is the case where you are looking at doing things that are good for my division, but not necessarily for the company as a whole. It encourages managers to focus on the short run at the expense of the long run. You can make decisions in the short run that may improve profit, giving you a higher ROI, but in the long run is detrimental to the company. So calculating average operating assets, margin, turnover, and ROI. So beginning assets plus ending assets divided by 2 gives you the average. So this is the average, 10,000 in this example. The formula for margin is operating income divided by sales revenue. Operating income was 1,000,008, sales revenue 30 million, so it's 0.06 or 6%. Exam-wise, I do not care whether you express it as a decimal or whether you express it as a percent. As long as you can be converting that percent to a decimal or the decimal to a percent. Then turnover, those sales of 30 million divided by the average assets that we calculated of 10 million is 3. ROI is margin times the turnover, which is 0.06 times 3, which is 0.18 or 18%. Or you can calculate it directly as operating income of 1,000,008 divided by the average assets of 10 million, give you the 18%. So if it's just asking for the ROI, I would calculate it directly using this. I would not go through and calculate turnover and margin if you didn't need to. Residual income is an alternative to ROI for evaluating investment center. And it's the difference between the operating income achieved and the minimum acceptable return. The minimum acceptable return for that division is a minimum rate of return that management sets, and you're multiplying that times the operating assets. Okay? As long as the number is positive, you're doing a good job or you want to accept the project, the opportunity. If it's negative, you're not doing a good job. The problem is you cannot look at the magnitude, how large the residual income is, to compare divisions. Okay. So the advantage, it's a dollar measure of performance. So we're looking at dollar profit. The disadvantage is that it can discourage myopic behavior. You're looking just at your division, and you cannot compare among divisions of different sizes. So it doesn't allow the comparison that ROI does. So calculating residual income, this company had an operating income of $3,510,000, average assets of $19,500,000. Minimum acceptable return is the 10%. So we're going to take the 10% times the 19.5 million, subtract that from the operating income, and that's going to give you a residual income of $1,170,000. It is a positive number, so you are doing good. Or if we're looking at a new investment, because it gives us a positive residual income, it's something we would want to invest in. Okay. Economic value added is a little bit more complicated. You're looking at after-tax operating income minus the amount of annual cost of capital. If the number is positive, when you do this calculation, if it is positive, you are creating wealth. If it is negative, you are destroying wealth. That means you're not doing a good job. It is not an opportunity that you want to take. It encourages managers to use the existing capital as well as new capital. And we are going to calculate weighted average cost of capital. That's where the complication comes in. We're multiplying this weighted average times the capital that we have and subtracting that from the after-tax income. So here we go. We have three sources of financing. $2 million of mortgage bonds, paying 8% interest. $3 million of unsecured bonds, paying 10% interest. $10 million in common stock. The stock is no more or less risky than any other stocks. And we're also going to consider the rate of return on long-term treasury bonds, which is 6%. We need to know the tax rate, marginal tax rate, because we want to look at the after-tax effect on these investments. Okay, so since the stock is no more or less risky than other stocks, we need to know if there's a risk percentage, which this one does not have. So we're going to calculate the after-tax cost of each method of financing. Then we're going to do the weighted average cost. We're going to come up with a dollar amount of capital employed. We're going to subtract economic value added from operating income to see if it's positive or negative. So here's an example. The bonds pay 8% interest. After-tax effect is the tax rate times the interest rate to give us 0.048. Okay. The after-tax effect of unsecured bonds, interest rate is 10%. After-tax effect is 0.4 times the 10%. So that gives us 0.06. Cost of common stock, since it's no more or less risky than others, it's the same as the return on treasury bonds. So we have 6% on treasury bonds, 6% on the stock. That gives us a total of 12%. So these are the after-tax amounts that we're going to be using. We're going to look at what our total investment would be, which is 15 million. Okay. Total amount of capital that we're employing is 15 million. This is how we are getting funds. Capital employed is the cash that you're getting for operations. So 2 million divided by the 15 million gives us 0.1333, 1/3, nope, close to 3 million divided by the 15. Three divided by 5 is 20%, 15, and that is 0.6667. We are multiplying the percentage of that type of investment times the after-tax cost to give us the weighted cost. So 0.1333 times the 0.048 gives us the 0.0064. We're adding up these weighted costs. The total is 0.0984. So that's the weighted average percentage cost of capital. We're multiplying that times the 15 million to give us 1,476,000. Okay. So our current after-tax operating income is 1,583,000. We're subtracting the dollar amount of capital employed of 1,476,000 to give us a positive number of 107,000. Since it is positive, we are creating wealth. Okay. So when it's a positive number, it is something you want to accept, or since it is positive, you are doing a good job. So if sales and average operating assets for year 2 are identical to year 1, yet operating income is higher, year 2 return on investment compared with year 1 will be what? So we're increasing income, dividing it by the same average operating assets. So what's going to happen to ROI?
It's going to increase.
It should increase. Okay. So problem areas. Remember, you're using this for planning and part of the control cycle to take corrective action. So what kind of incentive pay do you have for managers that will encourage them to meet the goals? Managers may not have a high ability to achieve those goals. They may not want to work hard to try to achieve those goals. And they may want to spend the money on perks rather than on trying to achieve a better income. So how do you get rid of these problem areas or address them? You need to discover information about managers before hiring them. So you really need to look at what they've done in the past. And this is also for promoting them to other levels. You may not always be able to find out what they've done in the past. It's based on the information that they're providing to you. You need to make sure you're constantly monitoring managers and keeping track of what they're doing. And the incentive plan must be closely aligned to what the management goals are. Okay. So incentives should be tied to performance. You want to encourage goal congruence. You want the manager to do things that will meet the goals of upper level management within an organization. So you might increase salary. You might have bonuses based on income. You might have stock options, and you might have non-cash compensations. maybe allowing them an extra day of vacation. Bonuses based on reported income, you do have to be careful that managers are not doing things in the short term to get the bonus that are negative effect to the company as a whole in the long run. Okay, so salaries and bonuses, that's a cash compensation. How do you reward good management performance? You have raises based on performance. Bonuses give them more flexibility. Again, you have to be careful with bonuses though, so they're not doing things in the short run to improve their bonus. Okay, you might want to look at a combination of two of these. Many companies have salary ranges for the particular job description or job level. And so you want to be careful that you're not getting that individual outside of the range for that particular job. Okay. Again, it could encourage dysfunctional behavior because you're doing things in the short run to make yourself look good that are detrimental to the company as a whole in the long run. Stock-based compensation. If you're giving them stock, that means they have a share in the company. So they want their percentage of ownership to bring them dollars eventually. So they're going to work harder to try and achieve the goals. That's because they are part owners of the company. It does encourage goal congruence. If the company's profit is better, then the stock will increase or not decrease. Disadvantage is the share price can fall for reasons beyond the control of managers. So stock prices might be going down because of the economic situation. A stock option means that the employees have the opportunity to buy additional stock at a preset price. Now, when it's stock-based compensation, the employee has to be careful about having all of their retirement in the stock. So I'm talking about this from an individual perspective, not from the company perspective. Many employees that worked in Enron were excited to get stock because the stock always traded so high. The majority of their retirement was based on shares of stock. When the company went under, they lost all of their retirement accounts. So from an individual perspective, you need to be careful about having too much ownership in any one particular company, including the company that you're working for. So things to consider if you're doing income-based compensation. Single measures are subject to gaming behavior, and that is competing against another division. So you may do make short-term decisions, managers might, at the expense of long-term viability of the company or the division. So the owners and managers are affected differently by risk. Managers with their own capital invested may be less apt to take risk. Owners who have the ability to diversify some of the risk may prefer a more risk-taking attitude. So non-cash compensation. There is an important part of the reward structure. It gives autonomy in how you're doing the daily business. And so we're talking about perks here. So a fringe benefit that's received over and above your salary. So it might be an additional day of vacation for every year you've been with the company. Okay. So that's what we're talking about. Not a dollar-based, but a perk, some type of fringe benefits. So stock options and how they encourage goal congruence. We've already talked about that, but this is the way they stated it in the book. Okay. Transfer prices. We are talking about one division making a product or part of a product that can be sold outside or sold to another division. So if we were talking about batteries in a car, we could make the batteries to be sold outside the company, or it could be sold to the division that is putting together all the parts in the car. Okay, so you need to come up with a price for how much the selling division gets and how much the buying division pays. It becomes a revenue for the selling division. It is an expense for the buying division. You want to make sure that both divisions are happy with the transfer price. The transfer price for the selling division needs to at least cover costs. The transfer price for the buying division must not be greater than the outside market price. One of those two, if you're doing, you're hurting the company as a whole. So you need to make sure, remember, the revenue from one division becomes an expense for the other division. For the company as a whole, they offset each other. But you need to make sure you're not foregoing revenue outside by transferring below cost, and you're not increasing expenses by paying more than you could outside. So transfer pricing is extremely important. We are not going to be doing any problems related to transfer pricing. You do need to know the information that I just talked about. Okay. So transfer price, one division sells to another, one has a revenue, the buying division has an expense. So how to set it? Again, you're looking at performance evaluation, goal congruence, and preservation of the divisional autonomy. You need to make sure that both divisions are happy. And that's why I said what the minimum price would be and what the maximum price should be. Okay. So market price, that's the outside price for the selling division, and it's the outside price for the buying division. So you could have negotiated transfer prices. It might be happening in a situation where there's limited supply on the outside market for the buying division. So then you might end up negotiating what the transfer price would be. Okay. And then that is chapter 10. Problem-wise, you need to know how to calculate ROI, which includes margin and investment turnover. You need to know how to calculate residual income, and you need to know how to calculate economic value added. Okay. You need to make sure that when you're evaluating and rewarding managerial performance, there is goal congruence. So that covers the content of chapter 10. So you might want to refer to this when we're getting ready to work the problems. So that is the review of the PowerPoint. We need to stop here, Sri. Okay. So now we need to look at working problems from chapter 10. ROI, which includes margin and turnover, residual income, and economic value added. So let's go to need to get over here so I can see. Okay, here are our problem shells. All right. Remember, I said in many of the problem shells that I would have some of the information that could be in the multiple choice. So I've talked about decentralization. I talk about the 4 different responsibility centers. I've given you the formulas that you need to know related to ROI. And now we're going to do exercise 10.1. So for small division, we're doing small division. We want to calculate average operating assets, margin turnover, and return on investment. So operating assets, the average is beginning. And beginning is 6,394,000 plus ending of 7,474,000. We're dividing that by 2. Oops. And that's going to give us 6,934,000. Okay. Margin. Operating assets. Operating income, I'm sorry. 2,773,600. 2,773,600 divided by sales of 34,670,000. 34,670,000. That will give you 0.0848%. Turnover. Sales, which is right up here, that's our sales. 34,670. Divided by average operating assets of the 6,934,000. And that's going to equal 5.0. Oops. Okay. Then we have one more ROI. We could calculate it 2 ways. I'm going to calculate it as if I hadn't done margin and turnover already. So net operating income is 2,773,600 divided by average operating assets of 6,934,000. To make that a little bit larger, it's kind of hard to see. And that's going to equal 0.40 or 40%. Since we've already calculated margin of 0.08 times turnover of 5, that equals 0.40 or the 40%. Okay. Now we need to do this for the cleaning division. So what I'm going to do is copy this. Right there. So average operating assets will be 5,000,006 parentheses. 5,600,000 plus 6 million divided by 2, and that should give us 5,800,000. Calculating margin. Operating income is 1,252,800 divided by sales of 31,320,000. And that will give us 0.04 or 4%. Okay. Turnover. Sales were 31,320,000 divided by average operating assets, which was the 5,800,000. And that equals 5.40. ROI, operating income of 1,252,800 divided by average operating assets of 5,800,000 equals 0.216 or 21.6%, or we could multiply margin of 0.04 times 5.4 turnover, and that gives us the same number. It's quicker to just multiply these two small numbers, since you already have margin and turnover, to do ROI this way. Now, what if operating income for small division was 2 million? How would that affect average operating assets? Okay. So, which one are we doing? Small. Which one was 2 million? Oh, operating income, I'm sorry. How would that affect average operating assets? It wouldn't. Okay. How would it affect margin? Operating income is part of margin. So that would be 2 million divided by sales of 34,670,000. And that would equal 0.0577 or 5.77%. Okay, so it was, margin was for small 8%. So since in down, margin went down. How would have Turnover does not include income. It has no effect on turnover. How would it affect ROI? ROI will probably end up going down. Okay, so ROI, 2 million divided by 16. Average operating assets of 6,934,000. That equals 0.2884 or 28.84%. So since the numerator went down, the calculation will go down. Now, one of the things I want to caution you about when you're doing these numbers and pulling them on an exam is to be very careful about pulling the numbers. So this one right here that's in yellow is 1,252,800. Students tend to sometimes not do the 800. They're just in a hurry and they're not putting it in correctly. So be very careful when you are pulling numbers from problems to make sure you're doing them correctly. So I have included advantages of ROI and disadvantages of ROI in the notes. And then I've talked about residual income. I'm giving you the formula and what an advantage of residual income is and a disadvantage. Remember, residual income is an alternative. Problem is you cannot compare divisions of different sizes using our ROI, residual income. As long as it's positive, you're doing a good job. Okay, so we're using the same data. So for cleaning products, we're going to do small appliances first. So the income for small appliances was 2,773,600. Minimum acceptable return was the 8% times average operating assets of 6,934,000. That's going to give us 554,720. So residual income is a positive number, and it is 2,218,880. So as long 880. As long as it's a positive number, they're doing a good job. Okay. Now we're going to calculate this for cleaning products. So for cleaning products, the divisional operating income was 1,252,800. We're going to need to calculate minimum acceptable return, which is going to be 0.08 times average operating assets of 5,800,000. So we are subtracting $464,000. So residual income ends up being a positive number of $788,800. Okay. So as long as it is positive, you are doing a good job. We don't look at the magnitude. We do not compare the 2,218,000 to the 788,000. Okay. What if the minimum return was 9%? How would that affect the two divisions? Okay, so let's copy this one right here. This is 0.09. It's a larger number, so we would expect minimum acceptable return to be larger. And so that would be 522,000 even. So our residual income is still positive. $730,000. Oops, did I pull the right one? Cleaning products. Oh. Sorry, my babies are getting upset. Did I do cleaning products? No, I didn't. I pulled the other one. Okay, so I'm doing just one of these. This is 0.09. Well, this is going to be 0.09 times 5,008,000. Which is going to make this 522,000. This is still positive, but it's not as large of a positive number. But remember, you can't look at the magnitude when you are checking performance. Okay. So this one would be 730,800. Okay. So up here for cleaning products, it was 788,000. For cleaning products with 9%, it went down to 730,000. Okay. Now I'm going to skip that one. And I want to go to another problem, exercise 10-7. I want to do all of the ROIs together, okay? So we're going to do ratios, round your answers to 4 significant digits. We have frozen foods year 1 and 2, and we have canned foods year 1 and 2. So frozen foods first. In this one, they calculated average operating assets, so we didn't have to do it. So year 1, operating income was 420,000 divided by average assets of 4 million. And that's going to give us 0.105. Okay, 0, they want 4. Year 2, income is 434,000, so income went up, but average assets stayed the same. So we would expect the return on investment to go up 0.1085. So it did increase. Income increased, average assets stayed the same. Then doing margin, need to do 1. Operating income, 420,000. Divided by sales, which are 6 million. For year 1. So that gives us 0.07. For year 2, 434,000 divided by sales of 6,000,002. So both income and sales went up. And we ended up with the same one, 7%. Turnover. Year 1. Sales are, 6 million. Divided by average operating assets, that was 4 million, stayed the same each year. That's going to give us 1.50. Year 2 went up to 6,200,000. Average assets stayed the same from year 1 to year 2. So since sales went up, the denominator stayed the same. The turnover should increase, and it is 1.55. Okay, so that is frozen foods. Now, to do canned foods, I've copied them over again, so the numbers are right here. Year 1. Income is 2,400,000 divided by average assets of 1 million. That equals 0.2024. Okay. 0, 0. I don't know what I did. Year 2. 2,006,000 divided by 1 million. Oh, I know what I'm doing. I'm not picking up operating income. Picking up the wrong number here. Operating income is 120,000. Just 0.12. And this one, I thought it was large. Operating income is 117,000 divided by a million. 0.1170. Margin. Year one. Income is 120,000 divided by sales of 2,000,004. Equals 0.05 in year two. Income of 117,000 divided by sales of 2,600,000. So income went down, sales went up, right? So it should be smaller, and it's 0.045. Then turnover, year one, sales are 2,400,000 divided by average operating assets of 1 million equals 2.40. Year two for can division, 2,006,000 is the sales divided by the 1 million equals 2.60. Okay. So the change from year one to year two for each division in ROI for can division, the assets stayed the same, but income went down. So that's why ROI went down. Okay. In frozen, income went up while assets remained the same, which is why the ROI increased. Then ROI and investment decisions, we're going to use the same data as 10.7. Can division, which one is can division? Can division is the second one. They were concerned about their ROI. It was 0.2. Okay. So they have an opportunity to invest in two projects. They're independent of each other. So they can do fruit, juice boxes by itself, fruit and veggie pouches by itself, or both of them. So compute the ROI for each one. So let's look first at juice boxes. Operating income would be $6,250 divided by an investment of $50,000. And that gives us 0.125. Fruit and veggie is 3,800 divided by a $40,000 investment. Okay. And that gives us 0.095. That's separately. So compute the divisional ROI for each of the following 4 alternatives. So just the juice box is added. So we're going to take the original profit of 117,000 plus this profit of 6250 divided by the investment of, was it 1 million? Plus the 50,000. And that's going to give me 0.1174. Okay, for the fruit pouch. So again, I'm going to take the 117,000 plus the fruit pouch was 3,800. Divided by the 1 million plus the 40,000 investment. And that's going to give me 0.1162. Okay, both are added. Okay, so I'm going to do the 117,000 plus 6,250, 6,250 plus 3,800 divide by the 1 million plus 50,000 plus 40,000. And that gives me 0.1166. And if the status quo is maintained, it will be the same ROI, which is 0.117. Okay, so now we're looking at this, 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 and the current ROI. Okay, so assuming the divisional managers are evaluated and rewarded on the basis of ROI performance, which do you think the divisional manager will choose? The manager will only choose an alternative that will increase ROI. So we go from 0.1170. This does not increase it. Okay. This does not increase it. This one does. So they are going to use add juice boxes only. Okay. Now, all the other alternative does have a positive ROI. 0.095. So this is an instance where you have to be worried about competition, that you're doing something that's good for your division only and not considering the effect on the company as a whole. Okay, so they both are viable alternatives because they both have a positive ROI. So now I want to go to transfer pricing. We're not doing. So I want to go back now to EVA. Where's the problem on EVA? Okay. So we're going to go to brief exercise 10.3. We want to calculate the after-tax cost of each method of financing. So for mortgage bonds, the interest rate, this is in yellow. So mortgage bonds are in yellow. Unsecured bonds information is in green. And cost of common stock is in blue. Okay. So the interest rate for bonds is 0.04 minus 30% minus 0.04. Okay. And that should be 0.12. So 0.04 minus 0.012 equals 0.028. Unsecured bonds, the interest rate is 6%. So 0.06 minus 0.30 times 0.06 equals 0.06 minus 0.018, which gives us 0.042. Then the cost of common stock, the return on long-term treasury is 0.04 plus the risk factor of 0.08, which equals 0.12. Okay, so now we're going to plug these numbers in here. So this is 0.028. This is 0.042. This one is 0.120. So we need to figure out what percentage of the total amount that we're employing will be from mortgage bonds. So 2 divided by the 15 million gives us 0.1333. 4 divided by the 15 million, so it's double, so it's going to be 0.2667. 9 divided by the 15 million is 0.60. Okay. So the weighted cost, we're going to multiply the percent of the total times the after-tax cost. So for mortgage bonds, that's 0.0037. For unsecured bonds, that's 0.0112. For common stock, that's 0.072. So the total is 0.0869. That's the weighted average percentage. Okay, cost of cap. So the amount of capital employed is 15 million times the 0.0869 gives us $1,303,500. Okay. So calculating economic value added. So the after-tax profit was the 1,900,500,000, 1,196,500. So 1,196,500 minus the 1,303,500 equals a negative, a negative 107,000. So we destroyed wealth. Whoops, got a zero. Okay. So that was not a good investment based on the information we had. Now, what if the common stock was less risky than the other stocks and commanded a risk premium of 5%? How would that affect the weighted average cost of capital? Okay, so only stock is changing. So stock, the return on long-term treasury bonds was 0.04 0.04 plus not minus the risk factor of 0.05, and that gives us 0.09. 0.09. Okay. So mortgage bonds will not change. That's going to stay 0.0037. This will change. Unsecured bond will not change. 0.0112. What changes here is this becomes 0.09. So it's 0.06 times 0.09. And that gives us 0.072 right here. This one changes, sorry. This becomes 09. So 0.60 times 0.09 should be 0.54. 0.054. 0.54. So if you add 0.0037 plus 0.0112 plus 0.454, note it went down because the 5% went down. This ends up being 0.0689. So we're just transposing two numbers. So we're going to go down here. And we're going to multiply times that. And that's going to be 1,000,000 0.33 500. So we will have after-tax income of the 1,196,500 minus 1,033,500. And that ends up giving us, it's less. So it's a positive number, which is good. 163,000. So we created wealth. Okay. So that is working through chapter 10. So for chapter 10, you need to know how to calculate ROI, margin, turnover, residual income, economic value added, EVA. Those are the types of problems you need to do. Then you need to decide based on those ratios whether or not you would or would not invest in opportunities. Okay, so that covers all of chapter 10. So we have one more chapter to cover for this semester, and that is chapter 16. So we're going to stop here with chapter 10 and come back and start on chapter 16. So okay, so let's get started on chapter 16. First, we're going to review some of the PowerPoint. We won't be able to do all of it. So let's look at the PowerPoint for 16. So we are going to be looking at cost, volume, profit analysis. In doing cost, volume, profit analysis, we are going to be using the behavioral or contribution format of the income statement. So we want to determine using CVP, that's the common abbreviation for cost, volume, profit analysis. Using CVP, how many units or sales dollars must be created to break even. We're going to define that in a minute. How many units or sales dollars are needed to earn a specific profit? We will not be doing problems with multi-product setting. We will be looking at the graph, a CVP graph, and how changing the variables affect the CVP analysis. Okay, so break-even point is an important point for management. That is where you have zero profit. The meaning of zero profit is your sales revenue equals all of your costs, both variable and fixed. Nobody wants to operate below break even. If you're below break even, then you are showing a loss. Okay, we have two ways of doing it. I really don't think there are two different ways, but every book calls it two different ways. One is operating income and one is contribution margin approach. So the first thing you have to do is separate your cost into variable and fixed components. Variable cost, by definition, variable cost per unit does not change with changes in activity. Fixed cost in total do not change with changes in activity. If you had a mixed cost, you would have to separate any mixed cost into variable and fixed portions. Okay, we are looking at the company as a whole. We're not looking at individual divisions. So to do CVP analysis, we have 5 different variables. P is your selling price per unit. V is the variable cost per unit. Direct materials, direct labor, variable overhead, and fixed overhead. Variable selling and admin. These 3 are product cost. This one is considered a period cost. Most students make mistakes on CVP analysis because they forget that direct materials and direct labor are variable costs. Okay, now Q is the number of units sold. We will assume units produced equals units sold when we're doing CVP analysis. F is your total fixed cost. You have your fixed overhead, which is a product cost, and your fixed selling and admin, which is a period cost. Z is the variable that's used for your target profit or before tax profit. When we talk about after tax, we're going to add 2 more variables to these 5. Okay, so variable product cost per unit, direct materials plus direct labor plus variable overhead. Variable cost per unit, direct materials plus direct labor plus variable overhead plus variable selling and admin. Variable selling and admin is a variable cost, but it's a period cost, not product. Contribution margin per unit, the abbreviation, selling price per unit minus the variable cost per unit, the calculation for it. Contribution margin ratio can be expressed on a per unit basis or a dollar basis. So on a per unit basis, it's contribution margin per unit divided by selling price per unit. On a dollar basis, it is sales revenue minus variable cost, which is contribution margin in dollars on that behavioral format income statement divided by sales dollars. So we're using the contribution margin based income statement. That was explained to you in the review for chapter 3. When we talk about operating income, we're talking about before taxes. Okay, bottom line net income is after taxes. So the behavioral format of that income statement, which is not here, sales revenue. You take sales revenue minus variable expenses equals contribution margin. Sales revenue minus variable expenses equals contribution margin. From that, you subtract fixed expenses, and that equals your operating income, which is income before taxes. From operating income, subtract income taxes to get your bottom line net income. Okay. So the units required for a target profit. You're going to take your fixed cost plus your before tax income and divide by contribution margin per unit. Price minus variable cost per unit is contribution margin per unit. Okay. Break even means this target profit is 0. So they're simply taking the target income off and say it's fixed cost divided by the contribution margin per unit. I just remember that this is the formula for solving for units needed, and that target income is 0 at break even. Okay. So we have a few more minutes. So here are selling price is $400, direct materials, 80, direct labor, $1.25, variable overhead, 15, fixed costs that are overhead, 800,000, variable selling is a commission of 5%, fixed selling and administrative is 400,000. Okay. So you need to divide your cost into variable and fixed to prepare the contribution format income statement. Units sold, we solved for break even by using the formula. 7,500 units times selling price of 400 gives us sales revenue minus variable expenses equals a contribution margin in dollars minus fixed expenses. For fixed expenses, we added both fixed overhead and fixed selling and admin. So the fixed expenses equals the contribution margin when you have a 0 profit. So at break even, and this is a common multiple choice question, at break even, your fixed expenses equals your contribution margin. Okay. So if we wanted to transfer that into a profit of dollars, how many units are needed for 240,000 profit? Not break even this time, but a profit. Target profit, which was 0 for break even, is now put in as 240,000. You need 9,000 units to earn $240,000. Okay. So the contribution margin approach, it's simply fixed cost for break even divided by unit contribution margin. Well, selling price minus variable price per unit equals contribution margin. So I really don't think it's a different. It's just they're calling this contribution margin instead of giving you the formula for contribution margin. Okay. So the variable cost ratio is variable costs divided by sales dollars. Okay. So sales revenue is 100% minus variable cost ratio equals the contribution margin ratio, which is the contribution margin in dollars divided by sales dollars. So this is what they're calling the contribution margin ratio. Using the contribution margin ratio, if you want sales in dollars rather than in sales units, we're going to take fixed costs plus operating income divided by contribution margin ratio. That's when we want to solve for sales dollars. Okay, so let me stop there. And we're going to go to the PowerPoint. Not the PowerPoint, we're going to go to the problem shells for chapter 16. Okay, here are the 5 variables, definitions, brief exercise 16.1. Calculate the variable product cost per unit. Variable product cost or direct materials of $575. Plus direct labor of $1.25. Plus variable overhead of 60 cents. Plus variable selling and admin, 80 cents. Okay, so that gives you your variable, oh, no, we don't want 80 cents yet. Your variable product cost of $7.60. Okay, then we're going to add the variable selling of 80 cents. So this is going to be $5.75, $1.25.60, and that's going to be $8.40. Okay. Then contribution margin per unit, the selling price we said was $16 each. So 16 minus your variable cost of $8.40 gives you a contribution margin per unit of $7.60. Contribution margin percentage, P of 16 minus V of 840 divided by P of $16 equals 0.475. Okay. Fixed overhead, fixed total fixed cost, fixed overhead of $43,000 plus fixed selling and admin of 19. Gives you 62,000. Then they want to prepare an income statement for the year. Okay. They said we are going to Sell 12,000. So you're gonna multiply sales units times that cost per unit. So 16 for revenue. Direct labor is 575. Direct materials. Direct labor is $1.25. Variable overhead was 0.60. Variable selling and admin is 0.80. So this is not a general journal form. This is a report form where I have two columns. Detail goes in the inside column, subtotals on the outside column. So this one is 192,000. I'm going in here, so I'm going to have to put a dollar sign again. This is 69,000. This one is 15,000. Variable overhead ends up being 7,200. Variable selling and admin is 9,600. You have to have a subtotal when you have multiple accounts. I'm putting the subtotal right here. Okay. So I don't need a separate row when I'm putting it in the next column. So that's $100,800, giving us a contribution margin of 91,200. Then I'm subtracting the two fixed expenses. Am I on the right row? I think this was 43,000. That one was 19,000. That totals 62,000. So our bottom line net income is 31,200. Okay. Then, if selling expenses increased, product costs have no change. Total variable cost increases. Contribution margin decreases. So contribution margin ratio decreases. Total fixed costs do not change. Okay. You can plug those numbers in. So this is the contribution format income statement we just did. This is writing left to right instead of top to bottom. Q is common to both of these first numbers, so I'm pulling it out because I want every one of the 5 variables by itself. So this is what I refer to as the basic CVP formula. You can use this formula to solve 90 to 95% of the problems. This basic CVP formula. Okay. So I want to do one exercise. Brief exercise 16.2. So calculate the sales commissions, selling price, $68. No, where's the selling price? $320. Times the commission of 5%, so 0.05 equals 16. Oops, I forgot the equal sign. Okay. Variable cost per unit. Direct materials is 68 plus direct labor of 40 plus variable overhead of 12 plus variable selling of 16 equals 136. Okay. So contribution margin per unit, selling price, $320. It should be dollars there, not thousands. 320 minus 136 gives you 184. Now, whenever I can in working problems, I'm going to write out the costs that are part of variable cost per unit to keep reminding you to add direct materials and direct labor. Direct materials and direct labor are variable cost. Students leave those off when they're working problems because they don't have the word variable in front of it. So be very, very careful when you are working problems that you know there are 4 possible variable costs. Okay, so P was 320. V was 136. F 500,000 plus 116,400. $600 equals 616,400. How many units must they sell to break even? Okay, so plug the numbers into this formula. 320 minus 136 times Q minus 616,400 equals 0. The reason I use this formula is because you're not always solving for Q. Sometimes you might be solving for what selling price is needed. It's a lot easier to solve for P when you're using the formula in this format. Okay, so 184Q is equal to 616,400. So Q is equal to 616,400 divided by 184. And I got 5,162. Whoops, I didn't want to go up there. Okay, now if it asks for sales revenue, we've already solved for Q, so we can simply multiply by P, which is 320. So 320 times 5,162 equals in dollars. Somebody have a number for me? Anybody? Is anybody there?
1,651,840.
Okay. Or you can use this format. Okay. Contribution margin percentage is contribution margin of 320 minus 136 divided by 320. And what does that give you?
.575. Oh, yeah, 0.575.
Okay. So I can use this formula. PQ is equal to 0 plus 616,400 divided by 0.575. And what does that equal? Hopefully the same thing. Is it the same thing?
I didn't get that.
I didn't get the same thing either.
Is this one correct? Is this correct? Is 5162 correct?
Yes, 320 times
No, it's not.
5,162. Oh,
This one's not correct. That's what the problem is. What is that?
4350.
How much?
I got 3350.
Okay.
and then that gives us the other answer.
Okay. And so what is this?
1,072,000.
Even?
Yes.
Okay. So when I'm doing homework, I would do it both ways to check myself. Okay. So I just wanted to introduce chapter 16. We have a lot more to cover. We will not have class on Monday. I have a meeting I have to go to on Monday. So we will be taping the lecture Monday evening, and it should be available on Tuesday afternoon sometime. Wednesday is our review for the final next week. Okay. So Wednesday is the review for the final. I have made available the problems we worked in chapter 10. They should be available at 4 o'clock this afternoon. The answers to the problem shells for chapter 10. So you can go back and review that. Chapter 10 and chapter 9 homework are both due this weekend. So you do have the answers to chapter 9 and chapter 10 problem shells on Blackboard, in case you need to go back and work them again, or you need assistance when you're doing the homework problems. Okay. So that's it for today. All of you, please stay safe, stay healthy, and I will see you on Wednesday. Wednesday is the review for the exam, by Tuesday afternoon, you should have the PowerPoint, not the PowerPoint, the recording from Monday night available. So have a great rest of the week. Take care, everyone. Stay safe, stay healthy. Bye.
Bye-bye. Have
Bye,
a good one.
Professor.
Good afternoon.